David Morgan just dropped a warning that silver investors can't ignore. He says you don't have months, you have weeks. Not weeks before a price move, weeks before preparation becomes impossible. If you own silver, what happens next could catch you completely off guard. Welcome to Aussie Housing Report, your trusted source for comprehensive insights into Australia's property market. Today, we provide accurate updates on house prices, rent trends, and investment opportunities across major Australian cities. Let's get started. To understand why this warning matters, you need to understand where silver sits right now in the global financial system. For years, silver has been one of the most underpriced, misunderstood, and heavily distorted assets in the world. Its price has been dominated by paper markets, futures contracts, and leveraged positions that have very little to do with actual physical metal. That system works smoothly only as long as confidence remains intact. David Morgan's warning suggests that confidence is now cracking. One of the biggest issues he highlights is the growing disconnect between physical silver and paper silver. Around the world, demand for physical silver is quietly rising. Investors are buying coins, bars, and industrial users are securing long-term supply. At the same time, inventories at major exchanges are shrinking or being moved, and delivery times are becoming less predictable. This creates stress in a system that relies on the assumption that paper contracts can always be settled without problems. Once that assumption is questioned, the entire pricing mechanism becomes unstable. Morgan points out that silver is not just a monetary metal, it is a critical industrial input. Solar panels, electric vehicles, electronics, medical equipment, and defense technology all require silver, and most of that silver is consumed permanently. Unlike gold, which is mostly stored and recycled, silver disappears into products. That means supply constraints matter far more than people realize. When industrial demand collides with investment demand, the market doesn't adjust gradually. It snaps. Another factor driving urgency is global debt. Governments around the world are buried under obligations they cannot realistically repay. The only politically acceptable solution has been currency debasement, printing, borrowing, and rolling debt forward. This slowly erodes purchasing power and pushes investors toward hard assets. Gold has already been signaling this shift, with central banks buying at record levels. Historically, silver follows gold, then accelerates violently. Morgan's warning suggests silver may be approaching that acceleration phase. Interest rates also play a role. Central banks are trapped. If they cut rates, currencies weaken and inflation risks return. If they keep rates high, debt servicing costs explode and economic growth slows further. Either path creates instability. Silver thrives in unstable environments because it sits outside the banking system. It doesn't depend on counterparty trust, and it doesn't require permission to exist. That's why it becomes attractive precisely when systems feel fragile. Morgan has also emphasized timing, not price. Many investors make the mistake of waiting for confirmation, waiting for silver to break out, trend on social media, or dominate headlines. But by then, the preparation phase is over. Weeks matter because physical silver availability can disappear long before price charts reflect reality. Premiums rise, dealers run out of stock, and delivery delays become normal. At that point, owning silver becomes less about cost and more about access. There's also a psychological component. Silver markets are relatively small compared to stocks, bonds, or even gold. That means it doesn't take massive capital flows to move prices dramatically. Once momentum shifts and fear enters the equation, price moves can be fast and disorderly. Morgan's warning suggests that the conditions for such a shift are aligning sooner than most expect. Another issue he's raised is trust in financial intermediaries. Banks, brokers, and ETFs all rely on layers of promises. In normal times, those promises function smoothly. In stressed environments, investors begin to question whether they truly own what they think they own. Physical silver removes that doubt. You either have it or you don't. That clarity becomes extremely valuable when markets are under pressure. Importantly, Morgan is not predicting the end of the world. He's not calling for immediate collapse or chaos. His warning is more subtle and more dangerous because of it. He's pointing to a narrowing window where positioning still matters. A window where decisions can still be made calmly, rationally, and without panic. Once that window closes, markets tend to force decisions instead. For silver investors, this raises uncomfortable questions. Do you own silver as a trade or as protection? Do you rely on paper exposure, or do you have access to physical metal? Are you prepared for volatility, or are you assuming smooth markets will continue? Morgan's message challenges complacency. It forces investors to think in terms of preparedness rather than prediction. There's also a global angle to this warning. Silver demand is not confined to one country. Emerging markets, particularly in Asia, view silver as both a store of value and a practical asset. As Western financial systems struggle with debt and confidence issues, Eastern markets are increasingly focused on securing real assets. That shift matters because it changes who sets the marginal price of silver. When physical demand drives pricing, paper markets lose influence. Morgan's weeks, not months, comment also reflects how quickly conditions can change in modern markets. Information moves instantly, capital moves even faster, and sentiment can flip overnight. The illusion of stability often lasts until it doesn't, and when it breaks everywhere at once. Silver, being small and thinly traded, reacts more violently than most assets. The key takeaway from David Morgan's warning is not fear, it is urgency with clarity. He's not telling people to panic buy or speculate wildly. He's telling them to think carefully about exposure, access, and timing. In past cycles, those who prepared early didn't need to react later. Those who waited for certainty usually paid a much higher price, both financially and emotionally. As 2025 approaches, the number of unresolved risks continues to grow. Debt, geopolitics, energy constraints, industrial demand, and monetary policy all converge on silver in unique ways. Any one of these factors alone would be manageable. Together, they create pressure. Pressure doesn't always show itself immediately, but it always releases eventually. So when David Morgan says silver investors have weeks, not months, he's really saying this: the easy phase is ending. The quiet accumulation phase is narrowing. And the market may soon move from indifference to urgency faster than most people are prepared for. Thank you for watching Aussie Housing Report. Stay informed on Australia's housing market by subscribing and enabling notifications. We bring you accurate, timely, and actionable insights to help you make smarter property decisions.